Finance is a backbone and it is an oxygen for every company irrespective of its size. Every sort of a company requires adequate amount of finance and timely supply of it from the various sources. Basically, company requires the injection of regular capital for the two basic purposes. First is to satiate its needs for fixed capital, and second is to satiate its needs for the working capital. It means the need for fixed capital and the need for working capital together constitute the total capital requirement of any business. Now the question is that from which source, from variety of sources, how to garner this required capital. Broadly speaking, there are two conventional sources from which the capital is injected into the business operations. These two sources namely are the debt source and the equity source. It means the combination of debt and the equity together constitutes the total capital structure of any business. So, what is the debt route in capital structure? Debt route essentially means taking financial loans from the various banks and financial institutions. And these financial loans entails a company concern a cost of capital, and this cost of capital is nothing but the rate of interest. Now, this finance which is raised through debt route is not a permanent finance, it is called a temporary finance because the company has legal obligation to repay this debt amount to the lender. It means the company has a legal repayment obligation of not only the interest amount but also the principal amount within a stipulated currency of this financial loan. Now, the financial loan which is raised through debt channel can be of a small term, medium term or long term financial loan. The financial think tank of business organization, they are the authorities to decide upon the quantum of loan as well as the tenure of the loan. Essentially, they carry out kind of a financial prudence so that the vicious incidences, the toxic incidences like capital overhang, overarching of debt amount and the idle capital is necessarily avoided. Another route of capital structure through which the capital is raised to finance the business needs, that route is known as equity route. It means the company dilutes its ownership. The company issues certain amount of shares through the stock exchange, through the stock market. The common investors, they purchase these shares, and in this way the company gets essential capital through equity route. Unlike debt finance, finance through equity is always called as a permanent finance. Naturally, because in debt finance the company has a legal obligation to repay the principal amount as well as the amount of interest to the lender. But in case of equity finance, the company doesn't have any kind of legal obligation to repay the entire invested amount to the investors. But company can have, if it desires so, to deliver a kind of a moral obligation, and that moral obligation is that whenever the company earns the profit, the company will offer a share in the profit to the investor, and that share in the profit is essentially called as the amount of dividend, the payout which is given to the common shareholders. The investors community who invest their hard-earned money into the company's stock, into the company's equity, by and large, they are least interested in the dividend, but at the same time, they are more and more stakeholding involves in maximization of shareholders' value. What is called as a maximization of shareholders' value? Suppose a particular investor purchases a company's share for rupees 100, and over the time that share gets appreciated and its market value becomes rupees 1000. In that case, it is a net profit of rupees 900 to that investors, and the investors community, they are largely interested in this kind of maximization of shareholders' value. Then how this maximization of shareholders value takes place through the stock market? Again, it is an economics of demand and supply. When the demand for particular stock is more and the supply is limited, obviously the stock price gets appreciated and vice versa. There are certain economic forces which are instrumental for the appreciation in the stock prices. These are mainly the micro and the macroeconomic factors. The microeconomic factors, they are mostly related to the company concerned. That means the world-class management, the world-class technology, corporate governance, the brand image of the company, how the investors they perceive the particular company into their heart, soul and minds. All this together gets factored into that price of the stock, and the much desired appreciation takes place in the equity stock. Macroeconomic factors, on the other hand, they are external to the corporate concern, and they are related to the domestic as well as international economy. The happenings and the upheavals in the domestic as well as global economy can exert its influence on the stock price of the company as a whole. One of such macroeconomic factors which can influence the Indian stock market is that the foreign institutional investors, they are withdrawing their investment from the Indian stock market, and they are reparking their investment into the other stock markets of foreign countries which are quite lucrative, and this could have a negative influence onto the Indian stock market and the stock prices of the Indian companies. In this manner, how much capital the corporate has raised through a debt route and how much capital the company has raised through equity route, this together constitutes the total capital structure of the business, and every company tries to strike an optimal balance between the debt route as well as the equity route. Optimal capital structure means such a kind of combination, a judicious combination between the debt and the equity, wherein the consumer surplus is achieved, investor surplus is achieved, lender surplus is achieved, as well as the corporate surplus is achieved, and this is called as the optimal balance between the debt and the equity route. Now we will try to harp upon the fact that which route is more costly for the company, whether it is the debt route or the equity route, which cost a company more. The answer is that equity route is more costly for the firm. Now one may get perplexed when the finance through equity is a permanent finance and there is no repayment obligation onto the company, then how the equity financing is a costly affair? Naturally, because the equity finance requires the company to adjust and to iron out its various micros on a perpetual basis. The company has to maintain its quality, maintain its brand image, maintains all the peripherals which raise the image of the company in the eyes of the shareholders, in the eyes of the prospective investors community. Financing through debt is relatively a cheap option, relatively less risky, because the company has to maintain its track record of the repayment and its ability to honor its debt obligation to the various lenders. Even in case of liquidation, which is a tragic event, even in that case, the lenders are generally not at loss because they have the first priority to get back their funded amount. Similarly, in case of payment of dividends, the investors they do not have the first priority. The first priority is to the lenders. That means of various banks and financial institutions. They will get their portion of repayment first, and then the dividend payouts can be made to the investors. Another beauty of financing through debt is that the payment of interest is tax deductible. It means it reduces the corporate income tax, it reduces and mitigates the tax liability of the corporate. Some business firms they prefer debt route than the equity route. Such business firms they raise the large amount of capital through debt route, and such business firms they are called as highly leveraged firms. Like Adani Business Group of India, a gigantic conglomerate who operates in diversified verticals such as port, power, cement, infrastructure, green energy, 5G, so on and so forth. All these business verticals they are highly capital intensive, and the business conglomerate requires huge amount of capital, and most of this capital is raised from the debt route, and that debt, the total quantum of debt is well diversified, and that is why Adani Group today is called as a highly leveraged business group. Here is a caution: when business conglomerates are more reliant upon debt route, in that case the lending institutions of the country got to be very cautious, and they got to exercise a financial prudence and the due diligence. When highly debt leveraged firms they have more debt exposure to the public sector banks of the country, and in case of financial default, in case of economic downturn, it can spread the negative impact onto the entire economy. We cannot forget the economic crisis of September 2008 triggered by Lehman Brothers. During 2008 economic crisis triggered by Lehman Brothers, most of the economies of the world got slipped into the recession, and therefore incidences of aggressive lending, irrational lending, incidences of crony capitalism must be avoided in India. While lending aggressively to the Kingfisher, collateral was not taken, physical collateral was not taken into the custody. Instead, the brand image of the company was considered as the collateral, and the incidents took place which we are very well aware of. Since the recent past, we are observing that the ego clash between the two titanic business groups is taking place, and because of this ego clash, the financial prudence is being kept on the back burner. Such business groups they are hand in glove with the directors of the lending institutions. Sometimes they are the part of crony capitalism, but ultimately it all happens at the peril of economy and at the perils of taxpayers' hard-earned money. Since it has already become a well-established business case study, it won't be out of place to mention here the ego clash between the titanic two business groups, namely Jet Airways and Kingfisher Airlines. Unhealthy business competition between the two created a vicious business environment, and it led to a debacle of both. The news got spreaded that the Kingfisher Airlines is about to acquire Deccan Airlines, and that is going to give them a kind of market penetration, a kind of free air route, and that created a provocation, a vicious provocation in the minds of Jet Airlines. And then They also acquired Sahara Airlines. In this way, because of this unhealthy and unethical competition between the two, they started building toxic assets onto their balance sheet, and ultimately the balance sheet of the both groups became very much stressed. So the essential takeaways are that as it is highly essential that the businesses they must be financially fortified, but at the same time financial carnage, a possible financial debacle must be avoided. It is not kosher to create financial and emotional turbulence, financial and emotional roller coaster ride in the economy. Thank you so much. Have a serene day ahead. Thank you.